Right. Read this example, amortized cost example. Read this. On 1st January 2018, an entity bought 100,000 5% bond for rupees 95,000, incurring transaction cost of 2,000 rupees. Interest is received in arrears. The bond will be redeemed at a premium of 5,960 over nominal value on 31st December 2020. The effective rate of interest is 8%. So these are the given figures, right? So in order to get an idea about this amortized cost, we'll do this example. From this, we'll try how this amortized cost computed, right? Okay. Now you can see this is a amortized cost financial instrument. Why we call it? When you look at that two tests, right? We call that SPPI test, right? The first test is the SPPI test, right? Solely payment of interest and the capital, right? Interest and the principal, SSPI test, right? And we keep this instrument until it get mature. That the business model test is also satisfied. Both are satisfying. So we should recognize, we should measure these financial instruments using the amortized cost, right? Using the amortized cost. Now we are going to learn what is this amortized cost, right? When you read this question, you can identify on 1st January 2018, entity bought 100,000 5% bond for 95,000. Here you can identify they have purchased, right? They have purchased this 100,000 bond by spending 95,000. So you can identify there is a 5,000 rupees saving, isn't it? 5,000 rupees saving. Why? They have purchased 100,000 worth of financial instrument by paying only 95,000. There's a saving of 5,000, which is a gain. But they have also incurred transaction cost of 2,000, which is a cost. Interest is received in arrears, which means they are receiving 5% interest on annual basis. Remember this word in arrears. In arrears in the sense, now we'll say the useful life of this bond. I'm taking just an example. We'll say useful life of this bond is only 3 years, right? I purchased this bond in this day and I am receiving the interest in arrears in the sense I am receiving the interest at end of each year. End of each year. End of each year. I am receiving the interest at the end of the year, which called the interest in arrears. There also may be some instances we call interest received in advance. Interest received in advance. What do you mean by in advance? Today itself, this is the day I invested. Today itself I receive the interest. That is at the beginning of the period. So in this case, in the year 1 itself, beginning of year 1 itself we receive. Here beginning of year 2 itself we receive. What happened when interest received in arrears? We receive the interest at the beginning of, at the end of the period. What is in advance? We receive the interest at the beginning of the period. Clear, right? So in advance and in arrears, in the sense, if it is in advance, we receive the interest at beginning. If it is in arrears, we receive the interest in at the end of the period. So I believe that part is clear to you all, right? I believe that part is clear. Interest received in advance and interest received in arrears. So in this question, we have received interest in arrears, that is at the end of the period. That is at the end of the period. So which mean in 5 years, in so how many years this this is going to be mature on 31st December 2020. Start on 1st January. No? So 2018, 2019, 2020. That is going to be mature after 3 years. Right. So we are receiving, remember always we are receiving interest on this face value. Now, if in this case, we have purchased this asset for 95,000. Right, that's true. That is the money we spend. But when we are receiving the interest, we receive this interest on this 100,000 face value, nominal value. That is where we get the interest. That is the source, or that is the basis we use to calculate the interest, 100,000, which is the face value. So always, now you can see by investing this instrument, right, by investing this instrument, initially we got a gain of 5,000. Reason is 95,000 worth of 100,000 worth of asset we purchased for 95,000. So we got a gain of 5,000. Also we spent a cost of 2,000. Also in yearly basis for 3 years, at end of each year we are getting 100,000 into 5%, which is 5,000 interest. Right? So those are the gains, and top of that you can see the bond will be redeemed at a premium of 5,960, which means by the time we redeem after 3 years, when we are asking our money back, we are not getting the initial 95,000 invest. We are not getting even the 100. We are getting the entire 5,009. I mean, like, we are getting 105,960. 105,960. This is the amount that we are going to receive at the end. Clear? So you can see by investing this financial instrument, you are getting 5,000 gain at the beginning because you take it at a discount. Then you have to incur a cost of 2,000, and annually you are getting interest 5% into 100,000, and at maturity you are getting an excess amount of 5,960. So these are the returns that you are getting by holding this asset for a period of 3 years. Right. Now we'll see how this amortized cost works. Now you can see nominal value, or we call the face value of this bond is 100,000. Fair value of the bond is 95,000. Why? Because this particular financial instrument worth 100,000, but we can purchase that from the market for 95,000, which means we purchase 100,000 worth of asset at a rate of 95. That is the fair value of the instrument. Other than that, right? Okay, so here at the initially when we are purchasing this financial asset, we are getting 5,000 discount. So that is one gain that we are getting. Second thing is, there is a issue cost of 2,000. I told you earlier, right? When issuing this particular financial instrument, we are getting 2,000. We have to incur 2,000 transaction cost, which is our expense. Also, by holding this asset, I am getting interest income for the first year, which is 100,000 into 5%, 5,000. Second year also I am getting 5,000. Third year also I am getting 5,000. That is this 100,000 nominal value. When I am receiving the interest, always I am receiving the interest top of the face value of the asset. And by the time I am redeeming the asset at maturity, right, I am getting a premium of 5,960, because they are saying that if you hold this asset for a period of 5 years, by the time you redeeming, they are going to pay you another additional 5,960. So those are the gains that we can take, right? Those are the gains that we can take. If you take these 3 years, you are getting the discount in first year, right? Isn't it? Because by the time you invest in this asset, you are getting this discount. In year 1, you are getting that benefit. And also by the time you purchase, you have to incur transaction cost of 2,000. That is also a transaction cost relating to the first year. And you are getting interest over period 3 years, right? First year, second year, and the third year, 5,000, 5,000, 5,000. And also at redemption, you are getting a premium of 5,960. If you look at your profit or loss account, right? If you look at your profit or loss account over this period of 3 years, right? If you plot this into a P&L, you can see in year 1, year 2, and year 3. First year you have a, we'll say first year you have a return in somewhere here. Second year it drops. Third year it increase. That's how it happens. If you reflect this in the P&L like this way, right? If you reflect these gains in the P&L like this way, it will not appropriate. To eliminate that impact, what we are going to do is, we are using a concept called this amortized cost. What happened in the amortized cost, right? What happened in the amortized cost? These are the years, right? These are the years. You know, at the beginning of the year, you spend rupees 95,000, right? At the beginning of the year, you spend rupees 95,000. Also, top of that, you incur a transaction cost of 2,000. We learned in the previous session, when it comes to the amortized cost financial asset, initially, whatever the financial instrument, initially we should measure at the fair value. Initial measurement is at the fair value. If it is an amortized cost financial asset, what we should do for the transaction cost? We should add that to the fair value. So here, in year 0, our total cost or the total cash outflow will be 97,000. That means to purchase the asset, I need to pay 95,000. Transaction cost also I should add to this financial asset, right? I should add to the financial asset. If it is fair value through P&L asset, what should I do? The transaction cost charged to the P&L. But here, since this is amortized cost asset, we add this 2,000 to the, we add this 2,000 to this, we add this 2,000 to the 95,000. Clear? Right. So that is the first year cash flow. Year 0 cash flow, right? This is at the beginning of the period. Then what happened in year 1? I am getting 5,000, right? Year 2, I am getting 5,000. Year 3, I am getting 5,000. Other than 5,000, I am getting the maturity proceed of 105. Because you know, even though we initially invest 95,000 at maturity, technically we should get the face value. But here, top of that, this is a very good financial instrument. Top of that, they are paying us 5,960 premium also, which means I am getting cash inflow of 105,960. So in third year, therefore, I am getting my annual interest of 5,000 plus this 105,960, which come 110,960. Okay, right? So when I am taking these cash flows, I am taking what is the implicit interest rate in these cash flows, right? What is the implicit interest rates in these cash flows, where I am taking that as the IRR, I'm taking that as the IRR, which comes around 8%, right? Okay, shall we look at this from an Excel sheet, right? I'll open you up an Excel sheet and show you how we can get this, because at the examination from y'all it's not required to uh, calculate this IRR, but you should know how we should calculate this, right? Okay, I believe you all can. Right. I think that you can see the Excel sheet which I share. Yes, can you see the Excel sheet? Can you see the Excel sheet? Right. Okay, now I'm taking all the figures from this slide, right? Because we know this slide. You are familiar with this slide. Year 0, my cash flow is 97,000, right? I have a cash outflow of 97,000. I have a cash outflow of 97,000. So in my year 1, my cash flow is 97,000, right? And second year, in the first year, I am getting cash flow of 5,000. Second year, I am getting cash flow of 5,000. Third year also, I am getting cash flows how much? 110, 960. 110, 960. So these are my cash flows, right? So in Excel, there's an option called IRR. You can use it, right? This is the inbuilt function given in the Excel. You can double click on this, then it will ask you to select the total values and put a comma, and you can guess how much going to be this your answer. You can guess whatever it is, right? You can guess it may be 10%, it may be 20%, whatever. You can put a guess figure. That's what it asks. So we'll put it like 10%. In decimal place, 10% in the sense 0.1. So I'm putting 0.1 there. And the close bracket, and I'm enter this. What is the rate I'm getting? 8%. What is this 8% in the sense? This is the amortized cost rate, right? So at the examination, you will get this effective interest rate. You no need to calculate it, right? So amortized cost rate you will get. So that's what here also we have received. Now you can see they also have given the effective rate of interest is 8%. So they also have calculated using the same formula, right? So you also can calculate and see how it comes, right? Now we know how to get this IRR. IRR in the sense, IRR is the one we should refer as the effective rate of interest, where we used to recognize the amortized cost, right? This rate used to calculate the amortized cost, right? Now we'll look at this. We'll look at this. The definition for this amortized cost. Amortized cost together with the relevant terms is defined as SLFRS 9 as follows. What do you mean by this amortized cost? Amortized cost is the amount at which financial asset or financial liability is measured at initial recognition minus principal repayment plus or minus the cumulative amortization using the effective interest method of any difference between initial amount and maturity amount, and for financial asset adjusted for any loss allowance. Now you can recall we purchased this asset for 95,000. At maturity we are getting 105,000, right? We need to use particular rate of interest, right? We need to use particular rate of interest to calculate how this 95 become 105. That gap, right? We should use effective interest rate method to calculate and reflect that in our financial statements. Right? So that's what the basically the effective interest rate or the IRR does, right? IRR does is that, right? So you can see there are definition for the effective interest rate. Effective interest rate means the method that is used to calculate of amortized cost of a financial instrument and in allocation and recognition of the interest revenue or interest expense in P&L. So that is the method that we are using. Now, based on this example, right? I told you, if we use this one, if we don't use this amortized cost method, this is how it is going to charge to the P&L. If we are not using the amortized cost method, this is how it's going to be charged to the P&L. In first year, we have to charge 8,000 to the P&L. Second year, we have to charge 5,000 to the P&L. Third year, we have to charge 10,960 to the P&L. It is not a logical or technical method to be used, right? Okay, we'll see by using the same example how we can charge these amounts into the P&L, right? Look here, I will take this in again in the Excel sheet, right? So we are using this kind of a table to recognize this. Okay, we'll take this as the years. We know this financial instrument is a 3-year maturity period, 1, 2 and 3. So here we are taking balance at beginning of year. Here we are taking the balance at the beginning of the period, right, of this instrument, right, balance at the beginning of the period. Then we are taking the interest income at EIR. What was the EIR rate we calculated? That was 8%, isn't it? Yes, it was 8%. So this is the logic that we use to calculate this amortized cost, right? And third one is we receive interest received at 5%. And we get balance at the end of year. Right. Now, I think you will be familiar with these figures. Now, we are going to calculate balance at the beginning of the year, right? If you take a kind of a timeline, year 0, year 1, year 2 and year 3, right? This is the maturity period of ours now. This is the balance at the beginning of the period. This is year 1 in the sense that is at the end of the period, right? So when it comes to the year 1, this is a balance at the beginning of the year 1 of year 2, right? So that's how it goes. That's why we have taken that schedule here like that way. Balance at the beginning of the year in the sense this is year 0, right? Okay. Now we know initially we should use, how much is the initial measurement that we want to use? Initially, right? How we initially measure the financial instrument, we know initially how we should measure. We are initially measured at the fair value plus the transaction cost, right? So we are taking here initial measurement is fair value of 95,000 plus transaction cost of 2,000. This is 97,000, right? 97,000. Then we recognize the interest based on this opening balance. This is called, this balance at the beginning of the year, in the sense that is the opening amortized cost. We recognize this using this effective interest rate of 8%. Effective interest rate of 8%. Then in normal circumstances, I told you, right, in normal circumstances, this is how you should charge this income or the expense to the P&L. But we are not following that method. We are using the amortized cost method. This is amortized cost method. What is amortized cost? You take the initial value and multiply that by the effective interest rate. That is 7,760, and during the year we receive how much? 5% interest, that is 5,000. In first year we receive 5,000 of interest. So you have your closing amortized cost, that is opening amortized cost plus interest minus this 5,000. So you are getting 99,760 amortized cost at the second year. Next year, you are taking this as the opening balance. This balance as the opening, then 99,760. Then when you calculate the amortized cost for the second year, you are taking this initial, right? You are taking, how you calculate this? How you calculate this? You are taking opening amortized cost into 8%, right? Then second year also you are getting the same interest income, that is 100,000 into 5%, which is 5,000. So your second year end amortized cost will be 102,740. Right. Third year you are taking this balance as the opening, then you are getting 102,760. Sorry. Right? And you apply 8% effective. Always you are using amortized cost into the effective interest rate. Right? Third year it will be 8,219. And third year also you are getting, how much you are getting cash flow at the third year? How much of a cash flow you are getting at the third year? Right? So we took this 95,000 and 2,097,000 as the beginning cash flow, and each year we got 5,000, 5,000, 5,000. That cash flows also we took. At maturity, how much we are getting? 105,960. Look here. If we take only 5,000 here, what will be the closing balance? 105,960. So this is the money that you receive at the end of the right. See, this is the amount that we are getting at the end of the period, 105,960. Technically at maturity we are receiving that balance as well. Ne mature වෙනකොට ඒ අවුරුද්දේ interest එකත් අපිට හම්බ වෙනවා. Mature වුණා මෙයා 105,960 දෙනවා. එතකොට then our balance becomes 0. Now look at this column. I wanted to highlight the importance of this column. Okay, go and see this column. How much is the total of this column? How much is the total of this column? It's 23,960. That column balance is 23,960. This is the total return we got. Right. Okay. Now we go and see how much is the total of this column. How much is the total of these three? How much? 23,960. Here also we are getting 23,960. Here how much is the answer? 23,960. Now if you plot, earlier also I did that. If you plot this into a particular table, diagram, you can see, particular chart, you can see you have 8,000 in the first year, you have 5,000 in the second year, you have 10,000 in the third year. See the fluctuation to the P&L. What about this scenario? What about this scenario? This scenario will be like this. This scenario will be like this, right? It will be like this way. Understood? Because when your amortized cost increase, see, when your amortized cost increase, your return also increasing, right? So that logic is given when we are using this effective interest rate or the amortized cost. Understood? How we recognize this in the P&L? So first year we are recognizing 7,760 in P&L. Second year we are recognizing 7,981 in the P&L. Third year we are recognizing 8,219 in the P&L. So that's how we should recognize that in the books of accounts. So that is this amortized cost method says. Clear, right? So, okay, so shall we do this example? I think from this example is also we can learn the same theory little bit further. Okay, read the question 3. On 1st January 2018, Asia PLC purchased a debt instrument for its fair value of 1,000 million. The debt instrument is to mature on 31st December 2022 and entity intends to hold it to maturity, right? So one test is satisfying, business model test is satisfied, you hold it until it gets mature, right? The instrument has a principal amount of 1,250. What do you mean by principal amount? Face value is 1,250, like in the previous example 100,000, right? And instrument carries fixed interest at 4.72. That means we are receiving interest at 4.72. That paid is annually. EIR or the effective interest rate, what we used to do the accounting in the under the amortized cost is how much? 10%. Demonstrate how Asia PLC should account for the debt instrument over its 5-year term. Right. Now, from this, now at the examination you will get this EIR, right? So you no need to calculate it and see whether it happens, but practically you can put these cash flows into an Excel and see whether it happens. Right. Anyway, now when they purchase this asset on 1st January 2018, right? The instrument they purchased 2018. Asia PLC purchased debt instrument for its fair value of 1,000. How much they spent to purchase? 1,000. What is the real value of this? 1,250. This is called the principal value. When you receive interest, you receive interest not on this 1 million. You receive the interest on this 1,250. Because remember, always you are getting the interest on the principal value or nominal value or face value. Right? What is this 1 million then? That is the fair value. Purchase price is the fair value. We know that all financial instruments initially measured at the fair value. So they have given us the fair value, right? So fair value is given, okay, and we know how much is the instrument principal amount. Principal amount says this is what you get at the maturity, right? Okay. So initially we should measure at 1,000. Is there any transaction cost involved? No transaction cost, so nothing to be worried about that. Interest, we received interest at what rate? We received interest at 4.72. ඒ කියන්නේ අපිට cash හම්බෙන්නේ 4.72. හැබැයි අපි book කරන්න ඕනේ මොකක් use කරලා? P&L එකේ interest income එක විදිහට recognize කරන්නේ using the EIR of 10%, right? Effective rate of 10%. So you are receiving interest at each year 1,250 into 72, which comes for 59 million. On maturity, right? On maturity, how much you are getting on maturity? Is it 1,000 or 1,250? 1,250. Why? This is the principal amount, right? Therefore, the financial asset might be at maturity, you are getting 250. Right? How now you can see how much of return you are getting in year 1, year 0, year 1. How long this asset is? January 18, 19, 20, 21, 22, 5 years. Year 1, year 2, year 3, year 4 and year 5, right? So those are the cash flows, those are the tenor of the asset. In year 0, how much you spend? 1000 spend. What is the value of this instrument? Yeah, 5,000, right? 5,000. So you are getting a discount, right? First year you are getting a discount of 250. Year 1 you are getting interest income. How much? 59. Second year you are getting 59. Third year you are getting 59. Fourth year you are getting 59. Fifth year you are getting 59. Those are the cash flows that we are getting. But this is not what we recorded in the financials. දැන් මේව බැලුවොත් පළවෙනි අවුරුද්දේ P&L එකට කීයක් charge වෙනවද? මේ දෙන්නම P&L එකට charge වෙන්නේ first year එකේනේ. You are getting discount of 250 and 59 in the sense 309 P&L first year charge. Second එකපාරට second year එකේ drop වෙනවා. එහෙම නෙවෙන්නේ නේ. ආය අර විදිහට plot කරලා බැලුවොත් මෙහෙම තියෙන්නේ. මේව තමයි income එක. Which is wrong, right? It has to be like a we call it like kind of exponential. වැඩෙන එකක් කියන්නේ exponential එකක් විදිහට තමයි මේක තියෙන්නේ, right? Okay, now what we are going to do that using the effective interest rate. For that we can have this table, right? We know that initially I'm investing 1000. In 2018 I'm investing 1000. That is my initial balance at the beginning of the period, 1000. Then I'm recognizing the interest income to my P&L using the effective interest rate of 10%, right? So 1000 into 10 in the sense 100. I'm receiving interest in the first year, that is 59, and closing my balance will be 1041. Second year, this will be the opening balance. Again, I'm applying the effective interest rate to recognize the revenue or the income, and I'm receiving 59 cash, and end balance will be 1086. In third year also the same, fourth year also the same. In fifth year, you can see fifth year I am receiving 1250 plus that plus interest income. Then how much will be the closing balance? Closing balance will become 0, right? So this is what now ඉස්සලා මම කිව්වේ මතකයිනේ ඉස්සලා revenue එක recognize කරොත් මෙහෙම revenue එක තියෙනවා. Then revenue එක තියෙන්නේ කොහොමද? Revenue will be like this way. Understood? First year 100, second year 100, 400, 900, 30, 109. This reflect මේ total කීයද කියන්නේ? මේ total කීයද තියෙනවා? 100, 2, 3, 4, 500, 513, 526, 36, 46, 45, 145. I think so. Sorry, 500 and is it 545? It's 545, right? කොහොමද මේ 545 ආවේ දන්නවද? කොහොමද? Initially කීයක් වටින එක කීයටද ගත්තේ? 1000 වටින 1250 වටින එක 1000 වලට ගත්තා. එතකොට එතන කොච්චර ගේන් එකක් ආවද? 250. ඊට අමතරව 59 ගානේ මට අවුරුදු 5ක් හම්බ වෙනවා. කීයද එතන? 295. 295. How much is that total? That is 545. ඒක තමා අපි මේ වගේ logical method එකකට P&L එකට charge කරනවා. So that's what we are doing using this IRR or the amortized cost method, right? So you can first of all note this down, then we'll try to do it on a T account for you to understand the scenario. So shall we look how we're going to recognize this in a in a T account, right? Shall we see how we can recognize this in a T account? Right. Believe that you can see the screen. If not, please tell me, right? Okay, now this is the amortized cost, right? This is the amortized cost. And this is the amortized cost financial asset. Now in our example, we had a what is it? It's a debt instrument, right? It just say debt instrument. It's a debt instrument. Debt instrument. So what happened when you initially invest? You spend 1,000 rupees. Your cash book credit and debit here 1,000. Right? That is the first entry. Assume there's a transaction cost. Then cash book credit this the asset account debit this amount transaction cost. And how much was the right? How much was the interest cost or the interest? It is 100, right? It's 100. Now, how we recognize that interest income? We credit interest income. Remember, we are not crediting the interest income received, that not the 59. We recognize this interest income. Interest income using this effective interest rate. Interest income, we credit 100 and we debit it here. Interest in year 1. How much? 100. Then how much interest we received during the period? 59. You receive, that means you debit your cash book and credit here 59. Then how much is your amortized cost at the beginning of the year? It will be 1041. This is how you want to put the double entries. Second year, how much is the interest income? Second year interest income was 104. Then you credit in year 2 here 104. In year 2 PNL, what you are doing, you credit 104. And year 2 also you received interest received 59, and year 2 you are getting the year 2 balances. Likewise, you have to recognize it in the books, right? So this is how we want to recognize the interest income in the books of account using the effective interest rate method, right? Okay, right. Now we'll see. Now we are going to learn, right? Now we are going to learn a question that covers three scenarios. Three scenarios in the sense a financial instrument when it comes to the fair value through profit or loss, how to recognize, fair value through OCI, how to recognize, and fair value through amortized cost. The third category is amortized cost, how to recognize that. Okay. This common question will cover all three. We'll try to learn it slowly. Then we more or less done with the amortized cost part, right? Question number 4. Read the question number 4. On 1st January 2018, Toyo bought 100,000 5% bond for 95,000. The previous example itself, right? On 1st January 2018, we did this as the amortized cost example also. Then it's easy for you, right? 1st January 2018, we purchased this asset 105% bond for 95,000. So initially we are getting a discount of 5,000. Incurring issue cost of 2,000, interest is received in arrears. The bond will be redeemed at premium of 5,960 over the nominal value on 31st December 2020. The effective rate of interest is 8%. Also, it has given us fair value of these instruments at year 1 and year 2 also. We'll see why they have given that, right? Okay, now the first part of the question. Required. Explain with calculation how the bond will have been accounted for over all relative years if. First one, Toyo's business model to hold the bond until the redemption date. That means amortized cost asset. Why? You keep the instrument until it gets mature. What is the second category? Toyo's business model is to hold the bond until, right? The bond, second one, I'm reading the second one. Toyo's business model is to hold the bond until redemption, but also to sell them if investment with higher returns become available. If there's a good return, okay, I'm selling. What is it? Fair value through OCI. Third category, Toyo's business model is to trade the bonds in the short term, which means fair value through P&L, right? Either of these three models, we need to see how we have to recognize that in the books of account, right? First of all, what we want is, there is amortized cost, right? We'll see how we recognize that using the amortized cost. That's clear, which we have learned also, right? So, how they should recognize this? The business model is to hold the asset until redemption. Therefore, the debt instrument will be measured at the amortized cost. The asset is initially recognized at its fair value plus transaction cost. That's how amortized cost does, right? Okay. Fair value is 95. Transaction cost is 2,000. Total is 97,000. This will be the initial measurement, right? How we should subsequently make measured using the effective interest rate or the amortized cost method. Interest income will be recognized in profit or loss using the effective rate of interest method. So we are having this particular format that we follow, right? So in the first year, initial measurement is at the fair value plus the transaction cost, right? See, 97,000. We recognize interest using what? Effective interest rate of 8%, and we receive interest of 5,000 each year. So 99,760 will be the closing balance. That will go to the second year. That will go to the third year. Third year we are getting 5,000 interest plus. They are saying that at maturity we are receiving that with 5,960 premium. So with that that balance is going to be 0. So first year P&L, you are recognizing interest income of 7,760, second year 7,981, third year 8,290. That's clear now. Right. This is how you want to recognize that for the when it is fair value, when it is amortized cost. That's clear, right? You can quickly note this down. This is the answer for part 1. Right? Okay. So we go moving to the second category. The second question. What is the second? Explain with calculation how the bond have been accounted for all relevant. Okay, right. So here the second category comes. All right, right. See, this is the continuum of the same thing, right? So initially we recognize at the 95,000 and transaction cost will be 2,000 and first year interest income will be 7,760. That is this part, right? 7,760. Then we receive interest income of 5,000 and the closing balance will be how much? 99,760. So this is how you are recognizing, right? Done. In the year ended 31st December 2018, interest income of 7,700 will be recognized in profit or loss and the asset will be held 99,760 in the statement of financial position. At the examination, if you ask to recognize what is the amount that you want to recognize in P&L, this should be the answer, and what is the amount that you should recognize in the balance sheet, this should be the answer that you want to tell. This is what you want to recognize in P&L, this is what you want to recognize in the balance sheet. Clear? Right. Second one. Now, in second one, what happened? No. Right. Look here. Now, here what we have given is in the year ended 31st December 2018, what are the figures? In year ended 31st December 2019, what are the figures? You charge P&L 7,981 and your balance sheet figure will be 102,741. That's clear. And in year 3, in the year ended 31st December 2020, the interest income will be 8,219, right? 8,219 in the P&L and you don't have any balance at the end of the period, right? So that is the first method. Second one, part B. Toyo's business model is to hold the business until redemption, but also sell if the investment is high. What do you mean by that? It is a fair value through OCI financial instrument. You are not keeping until get maturity. If good rate comes, you want to sell that. Okay, now tell me, if it is a fair value through P&L, if it is a fair value through OCI, how initially we should measure the financial instrument? Fair value. What we should do for the transaction cost? Add to the asset itself. Subsequently measured at the fair value. Subsequently also we should measure at the fair value, where we should recognize the fair value gain or loss in OCI. That's how we want to recognize fair value through OCI financial instruments. Okay. Now we have a matter how we are recognizing a debt instrument in fair value through OCI. It's like this. Why? The reason is this company has intention to hold this asset until maturity, but if they get a good rate, they are selling that. Okay. For that purpose, we should have a mechanism to recognize, right? Try to catch the theory from this example, right? Okay. Now, as usual, we know initially, right? Okay. The business model is to hold the assets until redemption, but sales may be made made to invest in other assets will higher returns available. Therefore, the debt instrument should be accounted saying fair value through OCI. Asset initially recognized fair value plus transaction cost, that we know. Initially, we should measure at the 95 fair value plus transaction cost should be at as what we did under the amortized cost. When it comes to the interest income, remember when we recognizing the interest will be using the effective interest rate like what we did for the amortized cost. And asset must revalue to fair value. This is the key thing that you want to learn. Asset must be revalued to the fair value at the year end. Again, what you want to do, you want to remeasure these assets to its fair value. That's why the question has given you the fair values of each instrument at each year, right? Okay. And this gain, gain or loss, whatever it is, where you should recognize in the other comprehensive income. Right. Now we are going to learn how to do that. Okay, you may recall the figures what was there in the previous calculation, right? It's easy. So we are taking the year 1. Initially we measured 97,000. That's clear. Fair value plus the transaction cost. Then we apply 8% and recognize the amortized costs. Then we receive interest of 5,000. Then how much should be the amortized cost balance? 97,000 plus 7,760 minus 5,000. The balance should be how much? How much it was in the earlier? 99,760. 99,760 may know, 99,760. Here it should be 99,760. 99,760. But this is what sort of asset? Fair value through OCI. Subsequently measured at the amortized cost? No. At what value? Fair value. They have given how much is the fair value. So what do you want to do? You want to take this fair value. You want to take this fair value. Right? You want to take the fair value. This difference. Now you know, if you calculate the same assets closing balance using the amortized cost, your amount will be 99,760. That is under amortized cost. But under the fair value, it will be 110. This difference, right? This difference you want to recognize as what? Gain or loss in OCI. That's how you are going to recognize it. That's how you want to recognize that gain or loss. Otherwise, there is no way to recognize this. Okay, because you are receiving the interest also. Since you are receiving the interest, your intention is to hold these assets to maybe until maturity. You have to measure that using the amortized cost, where you apply that, and you take the amortized cost plus the interest minus the interest received. Then you are getting the amortized cost. You compare this with the fair value of the asset, and difference you recognize in OCI. That's how you have to recognize it, right? Now we know how much is the amortized cost at the end of the first year, right? So you need to take that amortized cost when you recognizing this interest income. Remember. Now, එකකට පටල ගන්න එපා. හරිද? දැන් අපි initially පටන් ගත්තේ මෙයා 97,000 දීලා. Why? Initially we measured at the fair value and we added the transaction cost of 2,000. Then when we recognize in the interest, we apply this opening amortized cost into the effective interest rate. Then during the year we received our interest income of 5,000. Then we have a closing amortized cost balance of 99,760. But since this is a fair value through OCI financial instrument, we need to remeasure it using the fair value. Therefore, we took into the books for the fair value of the asset while recognizing the difference of 10,240 in the OCI as a gain. But when it comes to the second year, your opening balance is now 110,000, isn't it? But you can't recognize the interest on that because that is not your amortized cost. When you recognize in the amortized cost, again you want to add the, or again you want to multiply that by that onto the amortized cost of the asset. Understood? You want to apply the amortized cost. So if you look at this table, right? If you look at this table, you can notice, right? If you look at this table, you can notice this will be identical to the answer what you got in the previous case. See, you are using the same amortized cost. But remember, you have to recognize the fair value gain or loss in where? In the other comprehensive income or the OCI. So this is how you need to calculate when there is a fair value through OCI financial instrument, especially debt instrument. This is a debt instrument, it's not equity. If it is the equity, no worries. Why? No interest. No. But when there is an interest, you want to calculate this interest always on the amortized cost. Always on the amortized cost. Right now, here you can see each year in we have taken the fair value. Here also we have taken the fair value. Third year in we sell the asset, therefore no fair value. So anyway, it will going to be mature at 105. We receive the cash, so there won't be any balance. So this is how you need to calculate the fair value. Any doubt you all have? Please ask if you have any doubt. So quickly note this down. This is how you want to recognize the interest income for the interest income, and gain should be recognized in the OCI. Right? Okay. So we'll see how we should recognize this in the ledger accounts. So this will be a financial assets measured at the fair value through OCI. Initially we measured at 95,000. Transaction cost also we added, and interest income we recognize using the amortized cost method. Then we receive the cash interest of 5,000, and difference we recognize, this gain we recognize where? In the other comprehensive income. That means we debit this asset account and credit in the OCI. Right? So your first year your closing balance will be 110,000, then closing balance will be anyway at the fair value. Clear? Right. So note that the amount recognized in profit loss as interest income must be same as if the asset was simply held amortized cost. Remember, right? That's what I told. Like what we did in the amortized cost, interest income should be applied here also by using the same principle. Therefore, the interest income figure will be as it is for the year 1. In the year ended 31st December 2018, interest income of 7,760 will be recognized in the P&L, and the revaluation gain or the fair value gain of 10,240 will be recognized in the other comprehensive income, and your closing balance in the balance sheet will be 110,000, right? So this is the answer for the first year. And in second year, what will happen? Second year, you will charge 7,981 to the P&L, right? And revaluation loss of 8,000. Second year, there's a revaluation or the fair value gain or the fair value loss of 8,891, and your closing balance will be 104,000. And year 3, your interest income will be 8,800 and 8,290, and you recognize a fair value loss of 1,259 in the other comprehensive income. So that's how it's recognized in the books when your business model to hold the bond until the redemption, but you have intention to sell that in the short run. Clear? Right. So that's it. We have done the second part, right? Then we'll move to the third category, which is what? Fair value through P&L, right? Toyo's business model is to trade in the short term. So it will be a fair value through P&L. So it's easy. So what do you want to do? Initially measured at, this is the fair value through P&L. So initially measured at which value? Fair value, right? So what you should do for the transaction cost of 2,000? Yes, that you need to transfer to the P&L, right? That you have to recognize in the P&L, and subsequently measure how? Using the fair value, different recognizing P&L. Good, right? So this is how you want to recognize. So you have a fair value of the P&L asset. Initial value is 95, and transaction cost you recognize in the P&L, right? Closing balance of the instrument is 110,000. You recognize this 50,000 gain in the P&L. Asset initially recognized fair value for 95,000. The transaction cost is 2,000. That is also charged to the expense to the P&L, right? In year 1, you are getting interest income, but isn't it? You are getting interest income. How much of interest income you are getting? 5,000. No? That directly you recognize as interest income to the P&L. Here we are not applying the amortized cost principle because that is interest income we receive, that you recognize in P&L as an income, and this gain is recognized in P&L sections. So this is how you want to recognize that in the first year, right? In 2019, the cash profit of 110% would be recognized. The financial statement may be recognized. මේක ජනවාරි පළවෙනිදා විකුණලා දානවා නම් අපිට සල්ලි හම්බ වෙනවා 1,10,000ක් මේ asset එක re-recognize කරලා දාන්න. So that's how you want to recognize in simply. Right? If you want, quickly note this down. Right, quickly note this down. Right. Okay. Quickly, we'll see some few questions. Right. Question number question number 5. Okay. Quickly. Question number 5. On 1st January 2018, Maggie lends 2 million to important supply. The loan, which is interest free, will be repaid in 2 years' time. The asset is classified to measure at the amortized cost. There are no transaction fee. The market rate of interest is 8%. Loss allowance is highly immaterial. We learn about that later. And required to explain the accounting entries. Okay. Now see, because why I have put these questions, because each of these questions has a different learning points. That's why I have put it. Here you can see this company has lent 2 million. Lend in the sense කාට හරි දීලා. ඒ කියන්නේ මෙයාට asset එකක් නේ. It's a financial assets in perspective of the Maggie. Right? It has lent 2 million to one of their supplier. මෙහෙම වෙන්න තියෙන supplier කෙනෙක් ඉන්නේ නැති supplier කියන්නේ නැති මේමයි පොඩි සල්ලි හදිසියක් ඕනේ මට පොඩක් ණයක් දෙන්න බැරිද කියලා. For how long? In 2 years period of time. පොඩි ණයක් කියලා. මමත් ණය දෙනවා. මගේ හොඳ supplier කෙනෙක්. So I can't ask interest also. So I am giving him an interest-free loan for a period of 2 years. This asset is classified to be measured as the amortized cost. Why we keep this as amortized cost? Because we know that this is also financial instrument. Because I have right to receive cash after 2 years. So I have to recognize this as either fair value through P&L, fair value through OCI, or the amortized cost. Is it fair value through P&L? No, because it's not for trading purpose. It's not fair value for OCI purpose also. It's obvious it's amortized cost because you keep until maturity, and maturity you receive the amount. Right. Okay, now we know that it's an amortized cost asset. Now the question is, this is interest free. If it is an amortized cost asset, initially how we should measure? Fair value. Will anybody, fair value in the sense what are the broader the understanding or the definition of the fair value? Fair value in the sense it's an amount which can be agreed by both parties, right? Maybe seller and the buyer both. Do you think in the market we can get loans interest free? Will somebody give us the loan interest free? No, never. But this can be happen to a known part, isn't it? There is one of my friend. He wants some money. I give him the money, but I am not charging any interest. That is possible. Why? He is one of my friend. Can you expect that at the fair value? You can't, no? Because there's a buyers. So the same theory can be applied here also. Here also you can't take this 2 million as what? The fair value of the transaction. Under SLFRS 13, we learn how to measure the fair value. We learn how many techniques? How many techniques we learn? We learn 3 techniques. Either we can use the market approach to get the fair value, cost approach, or the income approach. Either by using these 3 approaches, we can get the fair value. Now here anyway, I can't apply the market approach here because there's no market to this. There's no readily available market. There's no cost approach also can be applied, but I can do the income approach. What we did in the income approach, we got the present value of the future cash flows. It is like this. Now here, I am going to give this loan, right? I am going to give this loan to, I am giving this loan, or this Maggie company give this loan to their supplier. Today is year 0, year 1 and year 2. He is going to pay me this after 2 years. He is going to pay me this loan after 2 years. So what should I do? I should get the present value of this future cash flow. Present value of this future cash flow by using this discount rate of 8%. Right? Discount rate of 8%. Discount rate of 8%. When I'm discounting this by 8%, how much the figure that I'm getting? 2 million discount by using the rate of 8%, what the answer I'm getting? 1.71. 1.71. That is the present value. How we got this present value? 2 million divided by 1.08 to the power of 2. So you are getting 1.71. So that is the present value, right? Because this is how we want to derive a fair value, because there's no fair value. 2 million is not the fair value. I have given 2 million to one of my friend without any interest, which can't be the fair value. In that case, this is the best method you to get the fair value. Future cash flows, present value. Where's the fair value? So you take this as fair value. So this is how initially you should measure these kind of financial instruments. So what you should do, right? What you should do, you get that fair value, you get that present value, right? The loan is financial asset because Magi has contractual right to receive cash after 2 years. Financial assets are initially recognized at the fair value. Fair value is the price paid in ordinary transaction between two market participants. Here it's not market participants. Market participant would receive 8% interest on loan of this type, whereas the loan made to the supplier is interest free. Normally, if you go at the market, it's normally they are charging 8%, but this person is getting that on free of charge. It would seem that the transaction has not occurred on the fair value, therefore you need to get the fair value. The financial asset will not be recognized at price paid for 2 million, right? It's not the fair value. Instead, the fair value should be determined, right? This can be achieved by calculating the present value of the future cash flows from the loan. So you can get that 2 million divided by 1.08 to the power of 2, right? It should be to the power of 2, right? To the power of 2, right? So how much will be the present value? 1.71. Okay, now how I am going to put the double entry? Because today I am giving them 2 million. My cash book credit 2 million. Where to debit? Where to debit? 1.71 to where? Amortized cost financial asset. Where should I put the balance? Balance you should recognize in P&L. So what you want to do? You recognize a financial asset for 1.71 and balance 0.29 you straightly recognize in the P&L while crediting cash 2 million to reflect the outflow of the cash. This is how you want to recognize in year 1, right? Year 0, year 1, year 2, right? So what we did, by the end of the second year, I should get 2 million. Today, I got the present value. So this date, how I put the double entry? Okay, credit cash 2 million, debit financial asset 1.71, debit P&L 0.29. That was done. Now what should I do? Because how much is my, now if I take my financial asset account, what is the today's balance? 1.71. It should be reached to 2 million by the time of I am getting the money. What should I do? Well done. We should do unwinding. The unwinding concept will be applied. That is the amortized cost again. Right? So what we should do, the financial asset is subsequently measured using the amortized cost. So this is the principle that again I need to adapt, right? Balance at the beginning of the period 1.71. I am unwinding this using the effective interest rate of 8%, right? So first year it will be 40. Now here I am not getting any interest, right? So that's why the interest column becomes 0. And closing balance will be 1.85. This will be going to the second year, right? This will be going in the second year, right? If you take 31st December 2019, second year balance will be 1.85. This will be 0.15, no interest, and you are getting 2 million at the end of the second year. So this is how it happens. So what do you want to do in the first year? Interest income of 0.14 million recorded by the post in the following. So this is how you want to recognize it. How? Interest or the amortized cost financial asset account debit 14 and credit the interest income. Can you remember the first entry what we did? We charged P&L the entire 0.29. That is subsequently recognized in the P&L. Why? Always follow the theory, because financial instrument standards say initially all the assets should be measured using the fair value. This was not at the fair value, isn't it? Right? This was not at the fair value. Therefore, we got the present value of the cash flows and calculated the fair value, because after 2 years I am going to get 2 million. So I need to get the present value today, fair value today. So this is how you want to recognize. This is a loan fee. Loan is interest free, so no cash is received during the period. Financial asset will be carrying value of 1.85 million as at 31st December 2018. By 31st December 2019, the financial asset will have a carrying value of 2 million. This amount will be then paid to the supplier. Right? That is also clear. That is question number 5. Right? Okay. Now, read this one. Read this one. You can identify this is also very similar to the question what we discussed earlier. Oh, I would say little bit similar. But here also you have a learning point to learn. Point to learn. Create. A public limited company has entered into several employee-related transactions. The directors of Create would like advice on how to account for these transactions in the year ended 31st March 2021. Create generated interest-free loan of 10 million to its employee. Again, what? They are giving interest-free loans. Apita gila ganna interest-free loan marketing. Right. On 1st April 2020, right. The loan will be repaid, right? When they have given this on 1st April 2020, the loan will be repaid on 31st March 2022 as a single payment by employee. The market rate of interest for 2-year loan is 6% per annum. Samanyan gila bank loan may company and dealer, company and free then. But if you go and take the loan from the bank, they would have charged 6% of interest, which is the IRR or the effective interest rate. Any loss allowance would be ignored. Don't worry about this. Create is unsure how to account for this. Required advice directors how to do this. This is also similar like the previous one, right? But there's one learning point. What is it? To whom we have given this? Employees of the organization. We have given this to the employees of the organization. Which means, what sort of? Earlier when we recognize the interest-free loan given to the supplier, we recognize that directly as an expense to the P&L. But we have given this to whom? To employee. So it's a kind of an employee benefit. So we have to recognize this as under the employee benefit, not just in a P&L as an expense, but under the employee benefits. So that is the difference here. You can identify. The loan to the employee is a financial asset because it creates a contractual right to receive cash. Then loan company it's a financial asset because they will receive this money after 2 years. So it is obviously will be a amortized cost, right? SLFRS 9 financial instrument requires financial assets to be initially measured at the fair value. Normally the fair value is the price paid. However, interest-free loan is not taking place on the same term as would exist between market participants. This is interest-free loan. In this case, the fair value should be estimated by using the present value of getting the present value of the cash flows. The difference between fair value of the loan and the fair value of the loan, difference between the fair value of the loan and the face value of the loan will be treated as employee benefit under LKS 19. Understood the learning point, right? Because in previous we have given to a supplier In this case, we have given it to our employee, which means we have to recognize that as an employee benefit. So fair value of the loan is how much? You are giving 10 million, isn't it? You are giving 10 million, right? 10 million loan. By using the market rate of interest of 6%, you are getting the present value for a period of 2 years. So that's why you have multiplied this by 1 over 1.1006 into the power of 2, which means 8.9. So you have to recognize 1.1 as employee benefit, the difference, right? Then only it becomes the cash paid amount, it go to cash paid value. So your financial asset will get debit 8.9 million, and your employee compensation or the employee benefit expense, salary expense wage tamai, right? Employee benefit will be debit to the 1.1 and credit to the cash. Clear? Right. And on the other hand, this is also have to be amortized. මේකත් අර විදිහටම අපි amortize කරගෙනම අරගෙන යනවා, amortize කරලා, right? The employee compensation would be charged to the P&L over the period of 2 years. Basically, sorry. Now, when it comes to this, employee benefit, right? When it comes to this employee benefit, you are not directly recognizing this to the P&L in the first year. You are recognizing this. Right? You are recognizing this over the period of 2 years. Right? You are recognizing this over the period of 2 years. Clear? You are recognizing this over the period of 2 years, right? The employee compensation would be charged to P&L over the period of 2 years, recognizing on a straight line basis, 50-50 in this case, right? Would lead to half being charged to the P&L in the current period, whereas the other half would be recognized as a payment on the statement of financial position. The loan asset will then measured using the amortized cost. By following the same theory, we recognize that using the amortized cost, using the effective interest rate method. In this case, the effective interest rate will be 6% and the value of the loan in the statement of financial position as at 31st March 2021 will be 9.43, that is present value into that effective interest rate, right? You are charging 0.53 million to the 53 million as an interest income, not charge, you credit to your P&L this interest income while the other entry debit into the financial asset account. Right. Okay. Right. Here also another example, good example of a good theory to be learned. Look here what has happened. Another learning point. Aroma, a public limited company, operates in manufacturing sector. Aroma purchased an investment in part during the reporting period. Aroma has made a loan of 50 million to a charitable organization. Now what they have done is they have not given to supplier. They have not given even to the employees. They have given this loan to a charitable organization. Right? The loan was made on 1st April 2021. So this is the grant date, right? It was on 1st April 2020 and is repayable on maturity in 3 years' time. The interest rate on the loan is 3%. Now look here, interest rate in the loan, how much they have charged from that particular charitable organization? 3% interest. Aroma assess that an unsubsidized rate for such loan would be 6%. Unsubsidized in the sense, normally, if it is for a normal customer, we have to give in at the rate of 6%, right? But here what happened, since this is a charitable organization, they have given a loan at a reduced rate, subsidized rate of 3%. That means 50% interest waive off, right? The first interest payment was made on 31st March 2021. Aroma initially recorded financial asset at 50 million and reduced this by the interest received during the period. Discuss with suitable workings how the loan to the charitable organization should be dealt in the financial statement. Okay, so How we have to recognize this? Is it a, what sort of a financial instrument? It's a debt financial instrument because it's loan given. Then you can further divide either fair value through P&L, amortized cost, or fair value through OCI. What sort of? Amortized cost. Why? We keep this investment until it gets maturity after 3 years. Second thing is, when we are receiving the money, we receive the capital plus the interest. So that's how it happens. So it's like no doubt it's a amortized cost financial asset. Okay. Initially, fair value. Do you think they have given this at the fair value amount? I mean, like whether this transaction happened at the fair values? No. Why? Normal market rate is 6%, but they have given this for them at 3%. Again, that question comes. This is not at the fair market price. So we have to follow the same theories, right? SLFRS 9 financial instrument says that financial assets should be recognized initially at the fair value. I think we have told this several times, right? According to SLFRS 13 fair value measurement, this is the selling price of an asset in an ordinary transaction between market participants. But here what happened, it's not market participants, it's a charitable organization. Market rate for similar loans attach the interest rate of 6%. Whereas the loan advanced to the charitable organization only attracts the interest rate at 3%. As such, price paid by Aroma of 50 million is not indicate the asset's fair value. This is not the fair value. Fair value of the financial asset must therefore again we have to be determined. This can be achieved again calculating the present value of the future cash flows. Right? We know what is the fair value of the financial assets, how we can get the present value of that. Because you know why? In 2021, how much of interest we are getting? We have given the loan at 50. But we are receiving interest of 3%. 50 into 3% in the sense 50, 1.5 million. So in first year we are getting 1.5 million cash by taking this asset. Second year, again we are getting 1.5. Third year also we are getting 1.5 plus. Third year we are getting this 50 million as a one-shot payment back. Now you want to take the present value of these cash flows using what? The effective interest rate or the market interest rate. So this you can consider it as the market interest rate. Understood? Because this is also not at its fair value. We need to get the fair value. So these are the cash flows that we are getting in the first year. First year we are getting interest at rate of 3%. Second year also we are getting interest at 3%. Third year also we are getting 3% plus we are getting this market rate. So you get the present value using the discounting factor. So in the first year you divide it by year 1, year 2 and year 3 and you get the present value of this asset. So this should be the present value of this. So now again you are following the same theory, right? Initially you should recognize, right? Initially you should recognize the asset, right? Initially you should recognize this asset. You paid cash of 50 million. Loan 50 million. But we are to debit financial asset debit how much? 46 P&L debit. That's how you want to recognize. You recognize that difference as a P&L expense, right? The financial asset should have been recognized for 46 million rather than 50 million. You should net recognize. Why it is not the fair value? You should have to get the fair value. So, are you clear how we got this fair value? We consider their cash flows, right? We consider their cash flows, future cash flows, and get the present value using the same theory, right? So, the difference of 0.4 or the 4 million, we have to charge as an expense on the first year itself, right? Charge P&L and credit to the financial asset. Then subsequently, since this is a amortized cost financial asset, again we have to use the effective interest rate to amortize it. By amortizing, we are recognizing the income because this is 46. 46 is your the fair value of the financial instrument. But when you recognize the interest income, you should recognize the interest income using the effective interest rate. You are getting how much? 1.5 cash received, and that is your closing amortized cost. So this is how you want to recognize that in the financial statement, right? So in first year, you recognize the interest income of 2.8 million by debiting financial asset and credit to the P&L. Clear the theory is what we learned, right? So that's why I have selected those additional questions, because I wanted to show you there may be the amortized cost financial asset, but which follows different theories, right? Always remember, initially you should measure the financial assets using the fair value, right? So that is the learning outcome that we got from all of these questions. So this is back the table, right? I think in financial assets we have discussed equity, fair value through P&L, fair value through OCI, and we were under the debt. Even there, fair value through P&L, fair value through OCI, amortized cost, which we discussed, right? So this is what we discussed. Theory will be same, but the next chapter or the next category is what? Financial liabilities. We know financial liabilities are divided into only two parts. That is fair value through P&L and the amortized cost. Same theory will be applicable, but earlier when we are discussing this financial asset, all the time we identify interest income. But here we recognize interest expense, because this is liabilities, loans that we are taking, right? So when it comes to these financial liabilities, we know financial liabilities divided into fair value through P&L and the amortized cost. Same theory will be applicable. Initial measurement at fair value. fair value. If it is a fair value through fair value through P&L financial liability, transaction cost, you have to charge to the P&L, and subsequent measurement, how you have to subsequently measure at the fair value while recognizing the difference in the P&L. If it is a amortized cost, again we initially fair value. If there's transaction cost, what you should do? This is a liability. Transaction cost, which like this. You take a bank loan. But you take a bank loan. What is the double entry when you take a bank loan? Cash book debit, liability credit. Okay, so we'll take amortized cost. It's also liability. Why we call it as amortized cost? We have to pay that on monthly basis or the installment basis. When we are paying, we pay the initial capital and the interest, and till maturity we make the payment. So it's amortized cost, right? So amortized cost, it's a financial liability. When we take a bank loan, debit the cash book and credit our liability. Here we credit. We'll say 10 million. Okay, right. We'll say bank wanted to write some sort of documents, legal document, loan agreement and blah blah things. When you sign those, lawyer have to involve. For him, we pay the professional expenses. Lawyer ki fee given, which is the transaction cost. What is the double entry? Cash book, credit, we have to debit. No. Cash book credit. Now we are at which one? We are at amortized cost. We learn if it is an amortized cost financial asset, transaction cost we add to the asset. Here liability, we deduct from the liability. See, now we'll say the double entry. Assume that we pay 500,000 lawyer fee, cash book credit, and debit it here. Understood? If it is a financial asset, transaction cost we add. If it is a financial liability, transaction cost we deduct. So you need to deduct from the liability. Subsequently measurement at amortized cost, where we recognize the difference in P&L. So the same theory will be applicable here also, right? We'll see this example, or not example, question. Question number 8. Look here. On 1st January 2018, James issue a loan. See, remember these words. අපි loan එකක් issue කරනවා. ඒ කියන්නේ loan එකක් issue කරනවා කියන්නේ we took a loan. We took a loan. අපි loan එකක් දුන්නොත් අපි කොහොමද කියන්නේ? නැත්නම් අපි මොනවා හරි asset එකක් ගත්තොත් අපි මෙතන කියන්නේ මොනවා කරනවා කියලා. invest. issue කරනවා කියන්නේ. ඒ කියන්නේ මෙහෙමයි පුතා. ඔතන issue කියන word එක මොකක්ද දන්නවද හරියට? දැන් හිතන්න මම debentures ගන්නවා මම debenture issue කරා කියලා. මම debenture issue කරොත් is it a asset for me or a liability for me? It's a liability for me. Why? I have issued one. මං දීලා තියෙන debenture certificate එක issue කරලා සල්ලි අරගෙන ඒක. I am issuing in the sense it's a liability. Remember that, right? So here also now we are talking about liabilities, financial. Here also the same. On 1st January 2018, James issued a loan. We have issued a loan in the sense we have taken a loan. Loan note with 50,000 nominal value. It was issued at discount of 60%. කවුරුත් ගන්නෑ මගේ debentures. එතකොට මොනවද කරන්නේ? හරි discount එකක් දෙන්න ගන්නකො කියලා දෙනවා discount එක. I have given them a discount 16%. Okay, 16% discount එකක් දීලා. Then at what price I would have been issued this? 50,000 worth of a loan note. I am issuing at 16% discount. How much is the discount? How much is the discount? Calculate and tell me. How much is the discount? Yes, Lamai. How much is the discount? 50,000 worth of liability I am issuing at a 16% discount. How much is the discount? ඒ කියන්නේ මම ණයක් දීලා මම ඩිබෙන්චර් එකක් ඉෂුව කරලා 50,000ක් වටින ඩිබෙන්චර් එකක් මම ඉෂුව කරන්නේ 8% ඩිස්කවුන්ට් එකකට. ඩිස්කවුන්ට් එක කීයද? Yes, quickly tell me. Yes, that's correct, Avishka. It's 8,000. ඒ කියන්නේ මම මේ loan එක issue කරලා තියෙන්නේ කීයකටද? 42,000. ඒ කියන්නේ ඇත්තටම මම loan මට ඕනි loan එකක් 50,000ක. මිනිස්සු කවුරුත් ගන්න නැතිද මිනිස්සු මට දීලා තියෙන ඇත්තටම 42,000. But I am bound to pay how? 50,000. ඒ කියන්නේ උනේ 50,000 වටින එකක් දෙන්නේ කීයටද discount එකකින්. But when I am paying back the loan I need to pay 50,000 again. Right? Clear? Okay, so 50,000 nominal value, it was issued at a discount of 16. The cost of issue were 2,000. ඒ කියන්නේ මේ loan එක issue කරන්න කොච්චර cost එකක් ගිහලාද? 2,000, which is the transaction cost. Interest of 5% nominal value is payable on annually. On annually, I need to pay interest to this or this. James need to pay interest. On what value? On 50,000. Remember, can you remember when we discussing that asset side also we calculate the interest income on this nominal value. That will be applicable for liabilities also. Even though I have received 42,000, doesn't matter. කවුරු ගන්න නැති ඉඳන් මම පොඩි discount එකක් දුන්නේ, but the nominal value will be always 50,000, right? It was issued at a discount of 16 nominal value. The cost of issue was 2,000. This is the transaction cost. We know that if it is a liability, the transaction cost should be deducted. Interest is 5%, paid in annual in arrears. Annual in arrears in the sense at end of each year. The bond must be redeemed on January 2023 after 5 years. I need to give the money back. Remember, with a premium of how much? 4,600 level. ඒ කියන්නේ මේක settle කරද්දී කීයක් ගෙවන්න ඕනද? 54,600 කොහොමදනේ ගත්තේ 42යි ගෙවන්න ඕනේ 54ක්. That happens, right? We'll say it like this. In Sri Lanka, if it is issued by a very famous government bank in Sri Lanka, 50 එකකට දෙන්න පුළුවන්. Why? People are waiting to buy because of the demand, because of the the financial health of those people. මිනිස්සු බය නැහැ. ඒ කියන්නේ අපි හිතමු People's Bank එක, NSB, BOC එක loan එකක් issue කරොත්, debenture issue කරොත් අපිට අංගාලා ගන්නයි. අපි දන්නවා මේක ගත්තොත් හොඳ return එකක් හම්බ වෙනවා. Maturity එකේදී මට සල්ලි හම්බ වෙනවා because those are state banks. We'll say if there's any recently developed finance, අපි අලුතෙන්ම දාපු මොකක් හරි finance company එකක් issue කරොත් people are very reluctant. They are thinking මේකේ සල්ලි දාලා අරකේ සල්ලි දැම්මා වගේ සෙලින්කෝ සල්ලි දැම්මා වගේ වෙයි. එහෙමනේ හිතන්නේ. So the people are very reluctant to pay. එතකොට ඒගොල්ලන්ට කරන්න දෙයක් නැහැ. හරියට 50000ක් කිව්වා මට 45000ක් දෙන්න කියලා ඒගොල්ලෝ discount කරනවා. To attract it, they are saying after 5 years, when you pay you back, we will pay 5,000 hours. Then it's become a little attractive. Then people tend to buy. So that's what it here happens. Also, they have given the effective interest rate as 12%. Now, you ask how to recognize this. Then අපි theory එක ඉගෙනගෙන තියෙන්නේ. ඒ නිසා asset එකට use කරපු theory එක අනිත් පැත්ත ගහන්න තියෙනවා. Income කියපු හැම එකක්ම expense වෙනවා. Right? Okay, we'll see. Initially, when you're recognizing, we know that whatever the financial instrument, initially you should measure at the fair value, no? So you know the nominal, the face value of this asset is 50,000. We provide them a discount of 16%. So initially we issue it at 42. Top of that, we have to incur transaction cost of 2,000 also. That is also we should deduct from the liability. How much is the initial value will be then? 40,000. හරි නේද? පැටලෙනවා නම් මේ බලන්නකො ඩබල් එන්ට්‍රි එකක් දැම්මොත් අපි නිකන් හිතලා. Liability එක. How much is the liability face value? 50,000. හරිද? 50,000. එහෙනම් අපි හිතමු අපි 50,000 එකටම issue කරොත් we receive cash how much? 50. cash book එක debit වෙලා 50,000 මෙතනට credit වෙන්න ඕනේ. හැබැයි මේ ගානම හම්බුන්නේ නැහැ. අපි discount එකක් දුන්නා. කොච්චරද? 8,000. එහෙනම් ඇත්තටම අපි ගාව අපිට සල්ලි හම්බෙන්නේ කොච්චරද? 42,000. හරි නේද? We debit cash book 42,000. We credit liability 42,000. ඒකටම transaction cost එකකුත් ගියා. අපිට transaction cost එකකුත් ගියා. What is the double entry? Cash book credit. You debit here. This is transaction cost. හරි නේද? net figure එක කීයද? 40,000. ඒක තමයි මේ උඩ අපි ගත්තේ. See? Initial recognition is 40,000. Clear? Right. Now, right. Initial measurement is 40,000. Subsequently, how we should measure? Using the amortized cost. Right. So, liabilities using amortized cost. අර විදිහටම තමයි. ඉස්සෙල්ලා මෙතන අපි use කරේ මොනවද? Interest income කියලානේ. Interest income. Then finance cost. Why? This is a liability. It's an interest cost for us. Right? Okay. So, this in year 1, initially measured at 40,000. Initial හරිනේ අපි ගත්තේ fair value and also we deduct the transaction cost. Using the effective interest rate, we have recognized this interest expense of 4,800. First year we need to pay cash. Cash කොහොමද ගෙවන්නේ? අපි හැම අවුරුද්දෙම මේ bond holder ට ගෙවන්න ඕනේ 5% on 50,000. 50,000 into 5%, 2,500. We need to pay that cash at each year. අපි cash ගෙවන්න ඕනේ, right? And your closing liability balance will be 42,300. This will be the opening balance of the second year. There also we recognize interest expense of 5,076. Cash outflow is 2,500. Closing balance of the second year will be 44,876. That will be the beginning of the third year. So you can see the third year figures, fourth year figures, and look at the fifth year figures. Now in fifth year, what happened? Your balance will be 50,996. Top of that, you recognize the interest expense. You pay the interest of 2,500. How much you need to pay at maturity? 50,000 plus premium of 4,600. That's what it's reflect here. 54,600 left. ඕන්නම් ඔයා එක මෙතනටම දැම්මොත් 54,611. This balance become 0. Clear? Right. So this is how we want to recognize. Now the matter is, right. Now the matter is, have you recognized this? Now you have a financial liability account. Financial liability account, right? You have financial liability account. Initially you measured it at 40,000. So your uh, how you recognize this initially? You pay cash of 42,000, you receive cash of 42,000 and your transaction cost was 2,000. So this is how this initial measurement happens, right? Then you should recognize the finance cost. What is the double entry for finance cost? This financial liability credit finance cost. Take an interest taker. Interest taker double entry මොකද්ද වෙන්නේ? Interest expense debit, interest expense. Now since this is a liability, it's interest expense. Interest expense debit 4,800 and credit here 4,800. Then we paid interest of 2,500. Cash book credit, this account debit 2,500. So when you take the total, first year you are getting balance of 42,300. So this is how you want to recognize the financial liability. We want quickly note this down. If anyone has any question, please ask. Right. So this is amortized cost financial liability. Right. On 1st January 2018, McGrath issued financial liability for its nominal value of 10 million. Interest is payable at rate of 5% in arrears. Liability is repayable on 31st December 2020. McGrath trades financial liability in the short term. Then at 31st December 2018, market rates of interest have risen to 88%. This is what they fair value through P&L financial liability. එහෙමත් වෙන්න පුළුවන් නේ. ඒ කියන්නේ අපි debentures issue කරලා ඒක trading කරන්න. කාට හරි ඕන transfer. Right. So initially we know that we should recognize this at the fair value, right? The financial liability is traded in the short term and so it's measured at the fair value through P&L. Initially we should measure at its fair value. So you can see the initially they issue it for the 10 million, right? That is going to be the fair value, right? At the beginning of the year, right? Assuming the fair value of the liability cannot be observed from active market, it can be calculated by discounting the future cash flows. Now here they have not given a fair value for this liability. එහෙම දීලා නේ නේ. ඒ කියන්නේ යා කියන්නේ මෙහෙම. අපි financial instrument එකක් issue කරලා තියෙනවා 10 million එකට. 10 million we have issued it and we are paying interest of 5%. But we know that since this is trading in the short term market, we should recognize this as a fair value through liability. How to get the fair value? Either you have to be given 10 million එකේ අද market value එක 12 million 2 million එහෙම කියලා දෙන්න ඕනේ. එහෙම දීලා නැහැනේ. Right. What they have given is they have given what is the normal market rate, effective interest rate. So what you want to do is you can calculate this. If you keep this financial instrument for a, we'll say for a 1 year period, you are getting you need to pay 0.5. That is 10 million into 5% interest you need to pay. And also, this is going to be repayable after 2 years. No? At maturity, you need to pay 10 million plus 0.5 for the second year. So, හරියට අපි අර කරේ අර reduce rate එකට interest එක දීලා තිබුණේ charity ඒ වගේම තමයි. So, you need to get the right here you need to get the present value of these cash flows. Present value of these cash flows, that will be 9.13, while right 9.13 because they have given 10 million, right, they have given this loan 10 million, they are paying interest of 10%, but at market rate it will be 10%. So what you did, you got the present value of these cash flows and get, okay, if you trade that in the market, this should be the present value in the market because we are paying 5% where the market rate is somewhere 10%. So you want to get the present value of that. Right? The interest payment now, annually you are paying interest of 5%. ඒක කොහොමද අපි recognize කරන්නේ? P&L එකේ expense එකක් විදියට. And this difference in the sense this 10 million and 9.13, that is 0.87 difference. You should recognize that in the P&L. Liability debit, because you have this liability. ඔයාගාව දැනට තියෙනවා financial liability එකක්. How much the financial liability you have? That is 10 million. හරිනේ මේකනේ අපි දුන්නේ යාලට. Closing balance should be how much? අපි ඒක remeasure කරගන්නවා to get the fair value 9.13. This should be the liability 9.13. So you recognize this 0.87 balance in P&L. Right? You debit the asset account and credit the P&L account. Liability එකක් නේ. මෙතන P&L එකට credit වෙලා තියෙන්නේ. අපි ගාව liability එකක් තියෙනවා. At pay books වල තිබේ 10 million, but in the open market it's 9.13. We are getting a gain. So you recognize this gain or losses in the P&L. Clear? Right. That's it. So we have discussed up to the classification, recognition and the measurement part of the financial instrument.